Going into the world of stock market trading is as tricky as it sounds. With that being said, discipline and emotion-free investing are crucial factors in stock market success. Emotions frequently blind your judgment, which leads to illogical decision-making in investment, which can result in huge losses. Discipline, on the other hand, encourages investors to stick to a well-thought-out investing strategy, even during chaotic market conditions. It is common knowledge that the stock market is very unpredictable. There are constant fluctuations in the market because of plenty of reasons. And because of this, investors, beginners, or experienced always feel FOMO, or the fear of missing out. Emotions like panic, greed, and euphoria get the best of them. And the outcome? Of course, jeopardy in your portfolio and money. Going to the world of the stock market is a continuous psychological battle in a financial endeavor. So, it is extremely important to learn how to invest with discipline and without emotions wringing you. Ready for your financial breakthrough? Welcome to Financial Literacy. Here, we are dedicated and passionate about bringing you nothing but honest and straightforward facts about your money. We will help you take control of your finances and bring you to the next level. Beginners or experienced, this is your one-stop shop for all things financial literacy. In this video, we will provide you with vital, free advice on how to handle the stock market with a strategic edge, ensuring that emotions don't dictate your actions. We are also going to dive into some of the most famous investors in the world. By learning the art of logical investing, you will be able to analyze market trends, evaluate company fundamentals, and efficiently manage risk. Well then, let's get on with it. Let's cover the basics first. So, what is the stock market? The stock market is a constantly changing marketplace where investors buy and sell ownership shares like stocks or equity in publicly listed corporations. It acts as a means for firms to raise funds by selling shares to the public and for investors to receive partial ownership in those companies in exchange for their investments. Now, in the stock market, there are some risks and rewards that come with it. Starting with some of the risks, one is the headline risk. When we say the headline risk, it is the stories that we see on the news or social media that would greatly hurt a company's business. Naturally, you don't want to invest in companies that have a bad reputation already. Another one, and I'm sure it's felt all over the world, is inflation. Of course, having inflation risks causes high rates when buying. If the rates go higher, no one will invest. Another one is ratings. Would you want to go to a restaurant with bad ratings? No, the same goes for stocks. Again, they have to maintain their credit rating. Another one is the economic risks. The company can go bad at any moment if the economy goes down. On the other hand, the potential rewards and benefits of stock market investing are very attractive indeed. One major advantage is the possibility of capital appreciation, as the value of stocks could rise over time. Successful investments can result in significant gains, allowing investors to build up wealth and fulfill their financial goals. It is not quick money, but it's sure to fill your wallets and banks. Another one, and it's the secret of many investors as to why they become successful, is a diversification. You can diversify your investments through the stock market by investing in different industries, sectors, and countries. This diversification spreads risk and lessens the impact of a single investment's poor performance. Moreover, the stock market has an accessible and wide range of investors to choose from. Companies that grow and expand contribute to overall economic growth. By investing in stock markets, you become a part of this growth in the economy. The world of the stock market is indeed very big, and without proper guidance, you will just lose everything. Now that you know the basics of the stock market, you should know the next big thing in the stock market. and that is to not let your emotions rule you. Howard Marks said, "The greatest challenge to controlling one's emotions is the difficulty of consistently putting your emotions in the background and the logic in the foreground." Disciplined trading is the core of a successful investment journey. However, allowing emotions to influence your stock market investment decisions can be the recipe for financial catastrophe. Discipline acts as an important foundation in navigating the complex world of the stock market. It helps investors stay focused on their long-term goals and disregard short-term fluctuations in the market. Investors may stay on track by developing a clear investing strategy that includes allocation of assets, diversification, and risk tolerance. A disciplined strategy helps investors resist the urge to chase after the latest market trends or take unnecessary risks. Remember, no emotions are allowed in the decision-making process of investing. As Peter Lynch said, "The key to making money in stocks is to not get scared out of them." Discipline and emotion-free investing go hand in hand. Investors can make appropriate decisions based on careful evaluation and research rather than emotion. You must understand that market fluctuation is a normal component of investing and that short-term swings may not always reflect the true value of a stock or the market as a whole. Remember that no emotion is needed when it comes to investing. With that said, being disciplined is not that easy. I know you know it. In line with understanding discipline and emotion-free investing, you should set up investment rules to help you maintain consistency and discipline while you approach the stock market. Having rules serves you a guide to help you make good decisions and not bad and impulsive ones. It is good to have a framework on how you can invest so you can easily navigate the complex world of the stock market, even if you are just a beginner, with confidence. One rule you should know is the 1% rule. In real estate, it implies that an investor should not put more than 1% of their overall portfolio at risk in only one deal. This rule is intended to control risk and keep a single loss from having a large impact on your whole portfolio. The 1% rule is useful as a starting point for determining the amount of rent that commercial property owners charge for real estate space. This rent level applies to all renters in both residential and commercial real estate properties. Another rule is the 5% rule, also known as the 5% markup policy, which recommends not putting more than 5% of your portfolio into a single stock. This rule encourages variety while avoiding over-concentration in a single investment. This rule requires dealers to determine commission rates reasonably and ethically so that the prices investors pay are appropriately associated with the market for the assets they get. Another thing you should know is the stop-loss order. A stop-loss order is a technique that traders and investors use to limit the amount they lose and reduce their level of risk exposure. A stop-loss order is an automatic order placed with a broker to sell a security, such as a stock, when it reaches a fixed price, known as the stop price or trigger price. The purpose of a stop-loss order is to protect an investor's capital by triggering a sale if the price of the investment moves against them. With this, you don't need to monitor your stocks daily, and this further helps you to not make hasty decisions. There are still a lot of investment rules you should know, and of course, researching is a vital skill you need to start investing. Find out what's best for you, and it would be a joy if you would come back to this video and just comment down what worked for you. Sticking to a long-term investment plan or perspective is the pillar of success, limiting the unpredictability of short-term market swings and developing a plan in line with your financial goals. This strategy allows you to take advantage of the power of accumulating returns, make good decisions based on basic analysis, and go through the market with confidence. By sticking to your investment plan, it helps you stay aligned with your goals. Change is constant, especially in the world of the stock market. Your plans should reflect the changes around you. The market, the trends, and the economic conditions change over time. Reviewing your goals and plans is essential to help you see potential threats and rewards as you go. Also, by doing this, you just help your portfolio become the best of it. An optimized portfolio is very beneficial in investing. By focusing on the long term, you can avoid the emotional roller coaster that market volatility brings. This allows you to see beyond short-term ups and downs, making it easier to stick to your investing strategy even during times of uncertainty. Instead of reacting recklessly to short-term market noise, you can adopt a patient attitude that recognizes the potential for significant improvement over the course of time. To end, remember that successful investors understand that the stock market is a long-term game, and they learn the patience to weather occasional downturns. If you follow a disciplined and emotion-free investment plan, you are more likely to make educated decisions, avoid monetary losses, and finally enjoy the rewards of your investments. And before you go, here's a quote from Benjamin Graham. "In the short run, the market is a voting machine, but in the long run, it is a weighing machine. Emotions have no place in investing. Focus on the fundamentals and invest with discipline." Well then, thank you for watching. If you like this video, please don't forget to give a thumbs up, comment, and hit that notification bell so you don't miss out on our next videos.